I was driving through the outskirts of Phoenix recently, miles of flat, dusty scrubland, when I came across a scene that, well, it looked like a sci-fi colony.
Oh, one of the new semiconductor plants.
Exactly, one of those massive new fabs. And the scale was just, it was overwhelming. A forest of cranes, a city of temporary trailers, and concrete trucks lined up as far as the eye could see.
Right.
So I stopped at a gas station overlooking the site, and I started chatting with this logistics contractor who was filling up his truck. And I expected him to be, puffed up with pride about bringing manufacturing home, the economic boom, all the usual headlines.
Of course.
But instead, he just looked exhausted, almost cynical. He pointed at the steel skeleton rising out of the desert and he said, "You see that? We are burning billions of dollars to build something that already exists perfectly fine in Taiwan."
Wow.
He told me it's taking 3 times as long and costing 4 times as much. And then he laughed, but it wasn't a happy laugh. He said, "We aren't building this for profit. We're building it for paranoia."
That contractor, he just got straight to the heart of the entire problem. That story is it.
It crystallized everything for me, that moment. We spent the last 30 years worshiping at the altar of efficiency, making everything faster, leaner, cheaper. But watching that overpriced concrete settle in the desert, it just hit me. The era of the peace dividend is dead. We aren't paying for efficiency anymore. We are paying a security premium.
And what looks like a construction boom, like progress, is actually the start of something else entirely. It's a historic, inflationary duplicate of the entire industrial world.
Right. For decades, the global economic engine was just fueled by this idea that peace and interconnectedness were permanent.
We optimize every last dollar.
Yeah.
Every single segment of the supply chain was designed to chase maximum efficiency. And today, that entire structural assumption is being dismantled layer by layer.
So that's our mission for this deep dive. We're going to formally analyze this reversal, this move away from 3 decades of, hyper-optimized global efficiency, what we used to call the peace dividend.
And straight into the world of geopolitical risk management, the world of the security premium.
Exactly. And the central mechanism driving this whole thing, the physical and financial manifestation of that premium, is what's playing out in Phoenix. It's the great duplication.
We are intentionally building redundant capacity, often at enormous cost, to mirror production chains that already exist perfectly well somewhere else.
I think we need to establish the context here just so everyone can grasp how massive this shift really is. If we look back, the old paradigm, the pre-duplication era, was completely focused on one thing.
Return on invested capital.
ROIC.
ROIC was the global religion.
It absolutely was. It drove these hyper-specialized, just-in-time global supply chains. If you could save a penny by moving a process to the other side of the world, you did it. No questions asked. Because that penny boosted your ROIC.
And that created a world where everything was cheap, everything was fast, but it was also incredibly brittle. It's so brittle. If a facility in Taiwan could produce a high-end chip for, say, $1, and an American facility's cost structure meant that same chip cost $3, well, the capital only flowed one way. It flowed to Taiwan.
And now that religion has been replaced by this just-in-case philosophy.
Precisely. The new paradigm mandates building that redundant, duplicated capacity, but only in regions that we deem secure or politically aligned.
And this is a conscious choice.
It's a profound, deliberate policy choice to lower aggregate productivity on a global scale. We are accepting that the product will cost more. We're accepting that the investment return will be lower, all in exchange for resilience, for sovereignty over the supply chain.
That accepted inefficiency. That's the inflationary architecture we're now being forced to build.
That's it, exactly.
Okay, let's unpack the mechanics of this duplication, because that's where the cost becomes, astronomical. It links right back to that contractor in Phoenix. The first and most glaring issue is this structural tax on the whole effort, which we're calling the Capex Multiplier.
The Capex Multiplier is probably the single biggest piece of evidence that the age of efficiency is over. In these really capital-intensive sectors, semiconductor fabs, high-tolerance machinery, specialty chemicals, advanced batteries.
The expensive, complicated stuff.
Exactly. The cost of building a leading-edge facility in the U.S. or Western Europe is not just slightly higher than in East Asia.
Yeah.
Our analysis shows it carries a structural multiplier of 3 to 5 times.
3 to 5 times. That's staggering.
It is.
We have to go into why. Why is the multiplier so immense? I mean, it can't just be the local hourly wage, right? Especially when these places are so highly automated.
It absolutely goes far beyond labor costs.
Yeah.
In a modern factory, labor is often a relatively small percentage of your total operating expense, especially with robots doing most of the assembly.
So where does that massive multiplication factor come from?
It comes from the complete absence of the established, highly specialized supporting ecosystem. It's the institutional memory that you just don't have.
What does that ecosystem actually entail in practice? What are we talking about?
Okay, so think about a modern semiconductor fab. It needs hundreds of miles of ultra-pure water piping. It needs specialized HVAC systems that maintain air quality down to the molecule. Complex, rare gas providers.
Right.
In Asia, you have 3 decades of specialized local subcontractors, plumbers, electricians, engineers who have built this exact type of facility 100 times before. They know the proprietary processes, they have the logistics down to the minute, and they operate at local prices honed by fierce competition.
And if you try to build that same thing in the Arizona desert?
You lose all of that. You lose the collective knowledge. You have to fly in consultants from other countries. You're paying them 10 times the local rate, and you're navigating entirely new permitting and regulatory hurdles that slow the entire process down.
So that infrastructure takes years, maybe decades, to build from scratch.
It does. That 3x to 5x cost is essentially a direct permanent tax on the productivity for that product line. And you're paying it simply because you are choosing security over the optimized supply chain.
This is where it gets really interesting because we have a story that just demonstrates this perfectly on the ground. It links that Capex multiplier directly to the final cost. Let's talk about Elias, a project lead for a new rare earth processing facility in Arizona.
Yes. This is a perfect illustration of what we mean by intentional inefficiency. For 20 years, Elias's company simply bought processed neodymium magnets, which are critical for modern motors, sensors, everything. Cheaply from these highly optimized Chinese supply chains. It was a friction-free, just-in-time process. The ideal.
And then the national security mandate comes down. You have to duplicate that entire complex chemical separation process on U.S. soil. So what did he run into?
He was immediately, as he put it, battling the ghosts of outsourcing. He's trying to replicate a precise chemical process that the original Asian supply chain perfected over 30 years of continuous refinement, trial and error.
He's fighting this profound institutional memory loss. The subtle tricks, the little bits of knowledge that just evaporated when the production line was shut down domestically.
And the cost of trying to replace that knowledge is astronomical. He's hiring specialized chemical engineering consultants who are charging him 10 times the rate of his former suppliers.
And I'm sure he's navigating a whole new world of regulations.
A whole new web of complex environmental, zoning, and safety regulations in the U.S. jurisdiction that either didn't exist or just weren't enforced to the same degree in his old international supply base. The friction he described is immense. It's physical and it's bureaucratic.
So it sounds like he had this realization that this was less about bringing efficiency home and more about just accepting really high costs for political stability.
That was his core realization. Every redundant pump, every duplicated vat, every kilowatt of energy required to run this parallel, less optimized system drives his final cost per unit up by 400%.
400%.
The security premium isn't an accidental surcharge. It is an intentionally inefficient path chosen purely for safety and supply chain independence. That 400% cost increase, that's the price of sovereignty.
And that inefficiency doesn't just stop once the factory is built. We're also seeing a complete reversal in how corporations think about inventory. For 3 decades, inventory was the enemy.
Absolutely. Wall Street vilified buffer stocks as, working capital inefficiency. Just-in-time delivery was the gold standard. It kept balance sheets lean and ROIC high.
And now?
Now the logic is completely flipped. Buffer stocks are now strategic insurance. Companies are willingly accepting higher holding costs just to reduce their geopolitical risk.
So we're seeing a secular rise in inventory days, the time products spend just sitting in storage across global corporate balance sheets.
And that's a tangible recurring cost. You've got storage fees, insurance, the opportunity cost of having your capital tied up in assets that are just sitting there.
And that cost, of course, gets passed through to consumers. It acts as a continuous negative supply shock.
Precisely. You are paying a recurring security premium embedded in the price of the goods simply because the company is forced to purchase resilience. We are witnessing an intentional global decision to lower aggregate productivity just to hedge against future disruption. This is a fundamental structural change in how capital is deployed.
Let's look at the implementation of this duplication. The policy drive is often simplified as reshoring, but the data suggests the reality is far more nuanced. It involves friendshoring, nearshoring.
That's a critical piece of context. The U.S. has certainly seen some success, but it's largely thanks to specific, targeted policy initiatives. We've seen significant job creation, about 2 million manufacturing jobs over the last 15 years.
Which is about 20% of total manufacturing employment.
Right, a combination of reshoring and foreign direct investment, or FDI, but the momentum is very concentrated.
Yeah, we know that almost half of that job creation happened in just the last 5 years.
Which demonstrates that it's being driven by major legislative actions like the Inflation Reduction Act, the IRA, and the CHPS and Science Act. The government is successfully allocating capital to projects that would otherwise be completely uneconomic.
So the CHPS Act, for instance, offers tax credits for R&D and fabrication incentives that are specifically designed to reduce that 3 to 5x Capex multiplier we just talked about.
Exactly. And similarly, the IRA provides these massive production tax credits that are driving the domestic EV battery and critical component ecosystem.
That sounds like strong accelerating momentum. But is it losing steam now?
The data suggests it is decelerating. Job creation peaked back in 2022 at around 350,000, and it has slowed since then.
And corporate appetite for full reshoring is maybe not as strong as the headlines suggest?
It's moderate at best. Proprietary surveys show that only about 20% of executives expect a significant relocation back to the U.S. The majority. They expect a mild relocation, and one can find a very specific, strategically necessary sectors.
Which means reshoring isn't some silver bullet for mass employment, so which sectors are actually seeing successful duplication?
Reshoring is most viable in capital-intensive sectors that are directly related to national security and where high levels of automation can effectively neutralize the high U.S. labor costs.
So we're talking about things like electronics, biotech, metals, and mining.
Electrical equipment, particularly EV battery components and computers. These are complex, high capex, high-tech operations. They are not the old assembly lines that relied on cheap manual labor.
And that brings us directly to the biggest limiting factor for widespread U.S. reshoring, which is the labor barrier.
Exactly. You can legislate the capital, but you can't legislate the skills. The primary risk that's deterring widespread U.S. reshoring is the lack of a sufficient pool of qualified labor willing to work for competitive wages.
So since these new production lines have to be heavily automated to overcome the Capex multiplier, the net impact on overall U.S. employment figures is probably not going to be massive.
It's unlikely. The cost of labor and the scarcity of specific high-end manufacturing skills are the primary concerns that continue to deter most companies from choosing full reshoring.
Okay, so if the U.S. market is too expensive and too labor-constrained for full reshoring, what's the geographically preferred alternative for firms that want to shift production out of China?
That leads directly to the overwhelming preference for nearshoring or friendshoring. This is the strategic reallocation of production capacity from a high-risk area like China to a friendly, geographically advantageous nation.
And the big winners there are Mexico, Vietnam, India, Thailand.
Those are the ones that rank exceptionally high as the major potential beneficiaries of this shift.
Mexico seems particularly well-positioned.
Mexico is considered a massive net beneficiary. You have the United States-Mexico-Canada Agreement, the USMCA, which provides an established regulatory and tariff framework. And the geographical proximity just simplifies logistics tremendously compared to moving goods across the Pacific.
Right, so we're seeing immediate benefits in sectors like transportation, food and beverages, home building suppliers.
All relocating to be closer to the final U.S. consumer market. That proximity reduces inventory risk, and it shortens the supply loop. You're still paying a security premium, but it's a much smaller one than full reshoring would entail.
Now, if we connect this to the bigger picture, this duplication drive isn't just about factories. It's about getting access to the foundational resources that you need for the future economy, specifically critical minerals and the energy for the clean transition.
And this is where the great duplication slams right into the reality of physical constraints. It's the revenge of geology and time. Policy can mandate building factories, but it cannot create the necessary raw materials or accelerate geological timelines.
Let's start with critical minerals. Because we prioritized efficiency for so long, the U.S. heavily outsourced not just the extraction, but crucially the processing.
And that dependence is now a geopolitical weapon. China dominates mineral processing. We're talking lithium, cobalt, rare earth elements, REEs, and they've shown a clear willingness to use that dominance.
We saw that in 2023.
We did. They restricted the export of gallium and germanium. These are two minor metals, but they're absolutely essential for advanced semiconductors, military tech, high-efficiency solar cells. It was a direct geopolitical response to U.S. trade policy. It was a warning shot.
A warning that the supply chain itself is now a primary foreign policy lever.
Exactly. And what's fascinating here is how geographically concentrated these resources are. It's far more so than traditional energy resources like oil or gas.
The concentration risk is severe. It just compounds the difficulty of trying to diversify.
It does. Consider oil. The top 3 global producers account for roughly 42% of supply. For critical minerals, the concentration is much, much tighter. The top 3 producers account for over 60% of the global supply for REEs, nickel, and lithium.
Which makes creating redundant supply chains incredibly challenging. Can you give us some specifics on that geographic concentration, especially on the processing side?
Certainly. So for extraction, the Democratic Republic of Congo provides 70% of the world's cobalt. China controls nearly 70% of global rare earth extraction. But the real bottleneck, the place where diversification is even harder, is in refining and processing.
Yeah.
Through 2030, an estimated 70 to 75% of the projected supply growth for refined critical minerals, lithium, nickel, cobalt, REEs, is expected to come from the current top 3 refining countries, one of which is absolutely dominant.
And for battery-grade graphite?
For battery-grade synthetic and spherical graphite, which is crucial for anodes, China will account for nearly 95% of projected supply growth by 2030. That level of market share means duplicating that capacity involves not just building mines, but replicating a massive chemically intensive refining infrastructure that took decades to build.
So this great duplication we're trying to fund runs directly into a structural bottleneck right at the source, and that bottleneck is time.
Time is the ultimate physical constraint. The physical economy operates on geological timescales, not political cycles or quarterly reports. Look at copper. It's often called the circulatory system of the modern economy. It's indispensable for every part of the energy transition: EVs, high-voltage grids, solar arrays, wind turbines.
And the demand projections are just astronomical as the world electrifies.
Exactly. Demand for copper by 2030, which is driven by all these electrification mandates, vastly outstrips the current pipeline of funded projects. The issue isn't the geology itself. The copper's in the ground. It's the lead time.
How long are we talking?
Developing a new world-class copper mine from the initial discovery through feasibility studies, community consultation, and finally to production, that routinely takes 10 to 15 years.
A decade or more.
This immense timing mismatch between accelerating demand and stagnant supply creates a structural deficit. It guarantees long-term inflationary pressure on the entire electrification effort. This isn't a cyclical shortage that just resolves itself with higher prices. It's a foundational structural shortage.
And are we seeing the same time pressures with other vital materials for the EV revolution, like lithium and graphite?
Absolutely. Lithium demand is expected to increase tenfold by 2050. That's primarily driven by the EV industry, which will account for about 90% of that growth. And while new lithium sources are being explored, the same long lead times for construction and processing apply.
And then there's graphite.
Right, which is crucial for battery anodes. The U.S. currently imports 100% of its natural graphite, and China supplies 42% of that. Demand is projected to more than double by 2030 just for battery anodes. Meeting these immense increases requires massive, geographically diversified supply chains that you simply cannot spin up in a couple of years.
So the U.S. is trying to revitalize its own critical mineral industry to mitigate this foreign dependence, but domestic production faces huge hurdles, even though we have vast domestic resources. What's the primary domestic bottleneck?
It's the permitting process. The U.S. permitting process for new mines is a massive bottleneck. It often averages 7 to 10 years and sometimes longer because of legal challenges.
And you compare that to 2 years in Australia or Canada.
Right, and they still maintain very robust environmental standards. A 7 to 10-year process creates so much uncertainty and risk that it discourages the necessary long-term capital investment.
And it creates a vicious cycle.
It does. That long permitting timeline forces developers to propose enormous mines just to have a chance at recovering the massive upfront costs and the prolonged delays. A larger mine inherently means a larger environmental footprint, which in turn fuels community opposition and legal challenges, which slows the process even further.
We see that with examples like the Twin Metals mine or the issues at the Thacker Pass lithium mine.
Exactly. So policymakers are looking for ways to speed this up without sacrificing environmental integrity.
What are the key mitigation strategies they're exploring?
They're focused on two major areas: bureaucratic streamlining and local buy-in. On the bureaucratic side, they're pushing for policies like Fast T41 coverage. This basically integrates and coordinates all the federal environmental reviews and authorizations under a transparent, enforced timetable.
So the goal is to make the process predictable. Take it from a decade down to maybe 3 or 4 years.
Exactly. And then for the local buy-in, which is often where these projects get mired in costly legal battles, that's where community benefits agreements, or CBAs, come into play.
These are proactive agreements.
They're legally binding, proactive agreements negotiated between the mining operator and the local communities before the project even starts. They address critical local concerns: local hiring targets, stringent water quality standards, resource management, environmental safeguards.
So by securing that local support early, developers get what they call the social license to operate,
which minimizes the costly delays from public resistance and protracted legal challenges. CBAs are fundamentally a mechanism to accelerate the project timeline by preempting years of litigation. They ensure the community receives tangible, enforceable benefits, which makes the project mutually beneficial rather than extractive.
So the lesson from geology and time is that the green transition is profoundly constrained by what you can physically dig up and process. But there's another collision point here: energy and infrastructure.
This is the second physical collision, and it contributes heavily to structural inflation. The energy transition itself involves a systemic shift from high-energy density fossil fuels to lower-density intermittent renewables,
which leads to a systemic decline in the energy return on investment, or EROI.
That's the measure of how much useful energy you get out for the energy you put in. Fossil fuels have traditionally offered a high EROI because they're energy-dense and easy to store and transport.
Renewables are cleaner, but they're intermittent and diffuse. They require far more physical capital to capture and stabilize the same amount of reliable energy.
Right. So a greater share of our total economic output has to be diverted merely to building, maintaining, and replacing the energy apparatus: the solar panels, the wind farms, the enormous battery storage units, the thousands of miles of new transmission lines.
And if we're diverting more output to the energy system itself, there's less left over for discretionary consumption or other productive activities.
That is the inflationary dynamic that's built right into the transition. It permanently redirects capital away from consumer spending and towards infrastructure maintenance.
And this demand surge is happening at the exact same time we're committing to this great duplication that must create immense pressure on the electrical grid.
It creates a collision course. You have a simultaneous surge in electrical demand from 3 major fronts, all competing for finite grid capacity. You have the new industrial facilities being built under the CHPs Act, the massive increase in EV charging infrastructure, and the explosive continuous demand from AI data centers.
AI data centers alone, the amount of power they require is staggering. If everyone is building at the same time, the grid becomes the choke point.
Precisely. We talk endlessly about chips and capital, but the immediate bottleneck for the next, say, half decade might not be either of those. It could be high-voltage transmission lines and substations.
You can incentivize a new factory in Ohio, but if the local utility can't get the right-of-way and complete the high-voltage upgrade, that factory just stalls.
The physical constraints of the grid, the need for permitting, copper, and specialized construction labor for transmission are profoundly limiting the speed of the entire duplication effort.
Okay, so we've established the necessity of this great duplication and the physical constraints, the Capex Multiplier, the 10-15-year lead times, the energy bottleneck. Now, let's pivot to the financial side. Who pays for all of this?
Well, since the private sector, which is still governed by that ROIC hurdle rate, won't voluntarily fund massively inefficient security-driven duplication, the state has to step in.
Right, and that's what we're seeing. Policies like the GPS and IRA Acts are fundamentally state direct capital allocation. The government is artificially boosting the return profile of projects that would otherwise be completely uneconomic.
Exactly. They are using subsidies, tax credits, and direct funding to reduce the effective Capex multiplier, making a $5 billion factory in the U.S. financially comparable to a $1 billion factory in East Asia.
This state intervention is the engine of the duplication, but it guarantees the normalization of large, persistent fiscal deficits moving forward.
The state is essentially going into debt to pay the security premium on behalf of the private sector, and this debt surge has to be managed. That leads us directly to the mechanism used to control borrowing costs in this environment: financial repression.
That phrase sounds intimidating.
It does, but it's historically common when state debt levels are high. Financial repression is the slow-motion debt management strategy where central banks are compelled to maintain policy interest rates below the prevailing rate of inflation for an extended period.
So if inflation is structurally running at, say, 4% because of the security premium, but the government keeps the benchmark interest rate artificially low at 2%, my cash and my bonds are losing real purchasing power every single year.
That is the modern mechanism of financial repression. It amounts to a slow-motion debt monetization that funds this industrial rebuild. Bondholders face a slow-motion default, not an outright restructuring, but a steady, deliberate erosion of their purchasing power.
And this effectively transfers resources subtly and continuously from financial asset holders like savers and retirees to the state and to the physical asset builders who actually benefit from the inflation.
That structural environment, persistent inflation and financial repression, is forcing a dramatic, fundamental change in how the largest institutional players in the world are viewing their portfolios.
It's a structural break. Sovereign wealth funds, central banks, they're now viewing geopolitical fragmentation, normalized interest rates, and entrenched inflation not as temporary cyclical issues, but as permanent features of the global landscape.
And they're aggressively moving away from the traditional static diversification models that failed them so badly during the recent inflationary shock.
This brings us to a really compelling anecdote about a significant institutional shift. Let's talk about Sarah, a seasoned pension fund manager. For her entire career, her strategy was rooted in the simple, reliable 60-40 portfolio.
The post-Cold War playbook: government bonds for safety, tech stocks for growth, based on decades of declining inflation and steady globalization.
Right. That model assumed both stability and asset correlation would always work in your favor. But that playbook is now considered obsolete by the sharpest institutional minds.
So Sarah faced these twin realities: greenflation driving up material costs for the company she held, and financial repression eating away at the safe return of her bond portfolio.
And she realized that paper assets were the most vulnerable things you could own in a fragmented, inflationary world.
So what was her aha moment regarding the Great Duplication?
She recognized that the only assets guaranteed to retain or gain value were those that were physical, scarce, and politically difficult to reproduce. The story is that she is now shifting billions of dollars of retirees' capital into hard, tangible assets.
We're not talking about stocks and bonds anymore.
Not at all. We're talking about things like investing in a massive new copper mining and processing infrastructure project in Chile, funding the expansion of deepwater ports in Vietnam. She's moving capital from the financial economy back into the real physical autonomy.
That's a profound shift.
Her logic, as she frames it to her team, is this: in a world defined by geopolitical fragmentation and the risk of asset freezes, owning the physical copper is actually a safer, more resilient asset than owning the debt of the country that consumes that copper.
She sees this Capex supercycle, driven by duplication and the security premium, as the defining investment trend of the next decade.
The only way to preserve real wealth. And that shift in institutional mindset confirms the central thesis. The investment preference is moving away from the intangible and toward the tangible.
Infrastructure is now the most favored asset class for increasing exposure among sovereign investors. It's closely followed by fixed income, which, interestingly, is being reassessed not just as a defensive anchor, but as a source of return generation and liquidity in a high-rate environment.
And how are these institutions leveraging the private credit market in this new volatile framework?
Private credit has rapidly evolved from a niche asset into a strategic pillar for the largest institutional funds. We see that 73% of sovereign wealth funds now consider private credit a core asset, with half of them actively increasing their allocations.
And why is that? What's the appeal?
It's valued specifically for its ability to offer bespoke structuring, which allows investors to tailor agreements to specific geopolitical risks. It has a lower correlation to volatile public markets, and it has the potential for higher yields, which helps counteract the drag of financial repression.
So the core investment logic has reversed. Value now accrues not to the asset that can scale digitally or be financially engineered, but to the tangible physical asset that creates a bottleneck.
That's the wisdom of hard assets. Value shifts structurally away from intangible assets like software and financial engineering to the tangible. The ultimate winners will be the owners of scarce physical bottlenecks. mineral resources, productive industrial capacity, and hardened logistics nodes like ports and specialized pipelines.
Moving from institutional funds to central banks, how does this environment of geopolitical uncertainty affect their management of national reserves, especially concerning the stability of the U.S. dollar and the role of gold?
Reserve resilience has become the paramount concern. Central banks are reinforcing their frameworks to build larger, more diversified, and highly liquid reserves to withstand sudden market shifts or, more ominously, asset weaponization.
And in that environment, gold has reemerged.
It has strongly reemerged as a core pillar of reserve resilience. It's the historical ultimate hedge against both inflation and political instability.
So what do the numbers look like?
A massive 86% of central banks already hold gold, and a significant 47% plan to increase those allocations over the next 3 years. Gold is valued not just as a historical safe haven, but critically for its political neutrality. It cannot be frozen or controlled by another sovereign entity.
So concerns over the weaponization of central bank reserves, like the freezing of assets for geopolitical purposes, is a view shared by over half of central banks.
56% of them, yes, which makes gold a necessary physical hedge against that kind of policy risk.
But despite all these political concerns, the U.S. dollar remains dominant. Is there a viable rival currency waiting in the wings?
This is the core dollar dilemma. The concerns are absolutely intensifying. A notable 72% of central banks believe that rising U.S. debt levels and persistent fiscal deficits, the very things funding this duplication, are negatively impacting the dollar's long-term outlook.
They flag political gridlock and debt sustainability as eroding its safe haven status.
They do. But if the world is so nervous about U.S. fiscal health, why aren't we seeing a massive exodus from the dollar?
The Tina principle. There is no alternative.
That's basically it. The alternatives are severely limited. The dollar retains its dominance due to its unparalleled liquidity, the credit quality of the Treasury market, and the sheer depth of U.S. capital markets. No single challenger currency, or even a basket of them, currently has the capacity to absorb a substantial reallocation of global reserves.
Not without causing immediate negative consequences for that currency's stability.
Exactly. The consensus among central bankers is overwhelming. 78% believe a credible rival currency is unlikely to emerge for more than 2 decades, or may not happen at all. Meaningful diversification will be agonizingly slow and partial, leaving the dollar as the uncomfortable yet necessary anchor for the foreseeable future.
We've covered the capital constraints, the physical constraints, but we need to close the loop on this Capex supercycle with the human element, labor. The Great Duplication means bringing production back, but that reveals a profound loss of manufacturing skill in developed nations.
The labor dimension is a critical and, frankly, painful contributor to structural inflation. You can't simply restart specialized, complex manufacturing after 30 years of deliberate outsourcing. The expertise is retired or it's moved into other sectors.
And that's perfectly illustrated by the story of Klaus. He owns a mid-sized manufacturing firm in Dresden, Germany, and he's trying to friendshore the production of specialized high-tolerance electrical components that were previously outsourced to Southeast Asia.
So he has the investment capital, he has the new automated machinery, he has the security mandate from his clients, but what he's facing is a massive systemic skill gap.
The local workforce in Dresden moved into services, software, higher education.
Right. The subtle, highly specialized muscle memory of high-end manufacturing, that tacit knowledge of how to run and repair those precise production lines was exported decades ago and is now incredibly difficult to reclaim.
So to get production running, he needs specialized labor immediately, and that labor is scarce.
Precisely. To attract the necessary skilled workers, the handful of engineers and technicians who are capable of running those specialized lines, Klaus has to offer wages that simply shatter his old pricing models. He has to pay a security premium for labor scarcity.
Which means he's bidding against other domestic industries for a finite pool of skilled individuals.
This is the definitive end of the global labor arbitrage game. For 30 years, capital aggressively chased the cheapest worker anywhere in the world. Now, geopolitical security mandates are forcing companies like Klaus's to bid for labor in closed, high-cost domestic loops where schools are scarce and demand is high.
So the ultimate outcome for Klaus is that the specialized component coming off his Dern production line is secure, it's friendly, it's high quality, but it costs twice the price of the old outsourced version.
And that doubling of price is the security premium manifesting directly in structural wage inflation. This dynamic, the normalization of domestic wages where the cost advantage of outsourcing has been neutralized by geopolitical risk, is a permanently embedded feature of the cost structure for duplicated goods. It will define the macroeconomic landscape for the foreseeable future.
So, to synthesize our findings here, the Great Duplication is not a temporary recovery or a cyclical boom. It is a fundamental structural necessity driven by the death of the peace dividend and the rise of the security premium.
Absolutely. We see its costs structurally embedded across the global economy. It's in the 3x to 5x Capex Multiplier for new secure facilities. It's in the 10 to 15-year lead times to bring essential physical commodities like copper and lithium online.
It's in the costly reversal of inventory logic, and it's in the institutional shift of sovereign wealth funds away from vulnerable paper assets and toward hard assets.
And the inevitable result of this reversal, this move away from a decades-long pursuit of maximum efficiency, is that the security premium is now permanently embedded in the cost structure of goods, defining the new macroeconomic regime.
Resilience has a mandatory structural and inherently inflationary price tag.
That's the takeaway.
And this leads to a foundational conclusion about where real value is going to accrue in this new world. The value is shifting dramatically from the financial economy back to the real economy. The next decade belongs to the industries that successfully address physical bottlenecks, energy, critical materials, and industrial security. It favors assets that are difficult to reproduce, geographically fixed, and scarce. As one industrialist aptly noted, the next decade belongs to things that hurt when you drop them on your foot.